At T-Mobile, our critical mission is providing unparalleled 5G coverage for when connectivity is mission critical. Introducing T-Priority, America's best 5G network experience for first responders, even in times of congestion. More capacity, faster speeds, better coverage. T-Priority from T-Mobile, built for tomorrow's emergencies, ready today. Discover more at t-priority.com.
For qualifying organizations on eligible rate plans, coverage not available in some areas and may be impacted by emergencies.
This is Fintech Insider News. This week, Taktile is here to tell us about their latest fundraise, Brex is here to tell us about their route to profitability, and as the world celebrates International Women's Day, we discuss what more can be done to fund female entrepreneurs. We'll be discussing all of this and more on today's show, so don't go anywhere. Hello and welcome to episode 943 of Fintech Insider. In a week where we celebrated Pancake Day, a glorious excuse to have pancakes for breakfast, lunch and dinner, Google it if you're not from the UK, I'm joined by a flipping great panel of guests to drizzle some insight over a fresh stack of fintech news. I would also like to add that I did not write that. First up on this week's pod, we have a warm welcome back to the show for Sophie Winwood, co-founder and CEO at Unlock VC and operating partner at Foxe Capital. How are you, Sophie? It's great to have you back on the show.
Yeah, no, really excited to be back. And very sadly was in Spain on Pancake Day, so did not have any pancakes. So, yeah.
Oh, yeah. You have to make up for it at some point this week. Now you're back.
Yeah, for sure.
Next up, we have a Fintech Insider debut for Art Levy, Chief Business Officer at Brex. It's great to have you with us on the show today. You've got some exciting news, which we'll come to a little bit later on in the show. But first, please can you tell us a little bit about yourself and your role at Brex?
Yes, so excited to be here. Thanks again for having me. So as you mentioned, I'm the Chief Business Officer at Brex, which means I oversee our business development, corporate development teams, our M&A, as well as our fundraising teams. I joined Brex in late 2018 as the 40th employee and have been with the company ever since.
Wow, well, it's great to have you on the show today and excited to come to your news in a little bit. And last but not least, we have another Fintech Insider debut, this time for Mike Taro-Wehmeyer, co-founder and CEO of Taktile. It's great to have you on the show as well. You equally have some exciting news that we'll get to shortly, but please introduce yourself and Taktile to our listeners.
Yeah, thanks for having me, Laura and 11FS. So I'm Mike Taro-Wehmeyer, co-founder and CEO on Taktile. You catch me in a great mood today. I'm sitting in a cabin in Utah, Sundance, at a customer advisory board. So if anyone ever wants to make your customers happy, you should invite them to a cabin in the mountains in Utah. Super nice. And yeah, Taktile is an AI risk decisioning platform that helps fintechs, banks, insurance companies to make smarter and better risk decisions. So we allow financial institutions to easily build, test, and deploy decision flows. So for an example, if you're Brex, you want to onboard a customer, you have to run a KYB check, then you have to make a credit check, which is decisioning again. And even if someone uses a Brex credit card, you got to do transaction monitoring. So that's an example of where a platform like Taktile could help. So, and yes, we do have some exciting news to share today. So I'm really looking forward to getting into that.
Amazing. Well, it's great to have you with us, particularly as you're on location in Utah. Thank you so much for joining us. And as you say, you have some news. So let's get started with that. So our top story this week, risk decisioning fintech Taktile raises $54 million in Series B funding. This story we picked up in Fintech Futures, but was in many other places as well. The AI platform just raised $54 million in Series B funding, led by Abrdn Capital, bringing total funding to $79 million. Banks and fintechs struggle to scale AI due to engineering bottlenecks, but Taktile has found success by giving risk teams the tools to build, test, and optimize AI-driven workflows. Taktile quadrupled its customer base in 2024, tripled revenue, and won major fintech and banking clients such as Mercury, Zelt, and Allianz. And obviously, we have the perfect person to tell us more about this. Mike, huge congratulations on the raise and all these numbers, tripling your customer base, quadrupling your customer base, tripling your revenue. What more can you tell our listeners about it beyond the numbers and how you reach those milestones?
Yeah, well, I mean, Maybe if we take a step back, I think, my co-founder, Max, and I, how did it all actually started? We were both ML engineers at a company called Quanco, which is a mini version of Palantir. And we were building ML models in financial services for quite a while. And over time, we realized, look, this actually is not how it should be. We need a much better platform. We need a mission critical kind of like platform for those type of decisions. So we started Taktile in 2020. And in the beginning, we wanted to actually concentrate on ML deployment. And after a while, it actually took us a bit of time to figure out what the right shape of the product should be. And then we relaunched the product in 23. So it's actually a pretty young product and grew that customer base, as you discussed, very, very fast. And we just had this incredible year, 24. And then, funnily enough, I always feel like these investors, Sophie, you probably know about that. They always know everything. Like, we're a private company, but somehow they're always on top of their game. So we did receive a preemptive term sheet for the Series B 10 days before Thanksgiving. And I remember I had planned a visit to my best friend in Kentucky who lives on a horse racing farm. So I told all investors, look, I'm going to be there in 10 days and I want to have the fundraising done by then. And 10 days later, fast forward, I think it was 1 p.m. when I signed the term sheet. Turkey came out of the oven and it was all done. Yeah, and now we got $54 million in the bank. Unfortunately, money is not free in this world, so expectations are also increasing heavily. But I think that's part of the game.
Amazing. That's a happy Thanksgiving for you, hopefully. That's an amazingly fast turnaround as well. Sophie, kind of from the VC perspective, what's your kind of thoughts on that growth rate and that investment turnaround?
Yeah, I think what's really exciting to see is AI all across the board is reinventing what good looks like in venture. And you saw Lovable raise a kind of Series A round, and they're adding 2 million ARR a week. But they're obviously with the prosumer consumer, whereas the AI for enterprises is seen as a lot more of a difficult battle, and a lot of companies are being very, very hesitant around deploying AI and AI solutions within their enterprises. And so seeing Taktile, having insurance companies, not even banks, but insurance companies as clients is a real show that this is a solution that is solving a real problem, and that the kind of speed of revenue growth and the speed of customer acquisition is very, very exciting. And obviously Bolton, great partner in the fintech space. So excited to see what's going to come next.
Fantastic. And Mike, can you tell us a little bit more about that kind of AI risk decisioning? Like, as Sophie said, you've got some big name customers, including insurers who are kind of risk averse by nature. What were the kind of the hurdles in getting this up and running and getting clients like that on board?
Yeah, that's a great question. I mean, like, AI as a technology, it's interesting, is powerful enough to make significant contributions in the world of risk decisioning. But then the question is, why is that not happening, more across the board? And also maybe before we came in. And I think maybe it's twofold. So, I mean, most companies just don't have the right infrastructure in place to make use of AI. So if you're a big bank, you're a big insurance company, it's just very, very hard to use it somewhere in your decisioning. If you're an insurance company, you want to optimize your claims or your underwriting. How do you actually do that if there's an open AI API somewhere on the internet? So I think that's very, very hard. And I think the second point is that many financial institutions still struggle to understand at which points in time AI actually can be used. So look, I would not use an LLM today for consumer underwriting. It's black box. It's very hard to interpret. It's very hard to do. I don't even think LLMs are particularly strong at this point in challenge. However, you can really use AI in the full kind of underwriting workflow if you're a B2B player like Brex, getting unstructured data into structured data, and then use kind of a more classical, let's say, linear regression or even rule-based system to then make the decision. So the combination of AI and rules, that's what's really, really powerful. But we've seen financial institutions struggle a bit to understand how to apply AI.
And Art, what was your thoughts on this? Obviously, AI just is making headway and headlines all the way across financial services. Is this sort of news like this a sign that we're at an inflection point for AI adoption, or is there still sort of skepticism in some niches?
Yeah, I think I'm a little bit down the middle on that, in the sense of I agree that there are enterprises, and it's a positive thing to see them starting to adopt and think through their AI strategy. But I do worry that it's more kind of one person in a room who's the VP of AI, because the CEO is like in a board meeting, bursts in and says, like, the board says we need an AI strategy, like, you go figure it out, versus like wall-to-wall deployment of solutions within enterprise customers. And we see it with our business in the enterprise segment, and how when we are selling into that segment, we really talk about our financial infrastructure and how we use AI to automate back office tasks. And you see it resonating with some customers, while others are not ready for that conversation. So I think it's definitely on its way to making waves in the enterprise. And it's impressive what Taktile's done with insurance and banks, because those are obviously two of the most obstinate types of customers. But I guess I'm not ready to declare victory just yet.
Fair enough. Sophie, you were kind of nodding there. I think, to Art's point, like we see a lot of AI in headlines, but, is there a lot of sort of parsing away of that you have to do in your role to kind of figure out if it is just one person in a room who's been kind of just had AI slapped on the end of their job title, or if it is an actual kind of significant part of the business?
Yeah, I think the problem is that everyone is doing POCs at the moment, because they're wanting to try things. But the failure rate of POCs, especially in financial services, is very, very low, because it's a low risk. You do a proof of concept on the side of the desk, try something interesting to say you've tried an AI solution, and then it never actually goes into production, because the leap from POC to production is, absolutely huge. And so you're having to kind of qualify. Yes, a POC, great with a financial institution, but what does that actually mean? What are the success metrics? And then how do we jump from that into implementation in a world where we're highly regulated, where we don't, we cannot trust, just anyone with customer data. And so I think in a way it should take a long time, because it's a really important implementation and technology. And so, we're just kind of weighing up those couple of things.
I think I very much agree with both of you. Like, I would say, like, Art, I would also not declare victory in AI and financial services yet. I think we're like very the early innings. And Sophie, you're so right. I mean, like, there's so many POCs. Like, we do see very great first results. So I'm deeply convinced of AI having a big impact in financial services. But yes, most enterprises are still at the POC level. I do still, Art, you said, like, there are many like CEOs of banks running around and want to do AI. I still like them a lot, because they help us. They help us to get started.
No, so you got to have a champion somewhere. They're with you. They're probably with you in Utah now. They're in the cabin with you.
I'll hunt them down in a minute. Yeah.
But coming back to that kind of those enormous sort of growth numbers that we talked about at the very top, sort of how did you go about that? Like, is AI the sort of biggest driver of that? As kind of we've been saying, everyone's sort of getting very excited about it, but no one quite knows where to start. So if you guys know what you're doing with AI, are you then sort of coming from a place of trust, and people are more likely to kind of trust you to help them figure it out?
Yeah, it was not even that. You would think it was the AI that drove most of the business, but B2B SaaS is a funny world. Like, there's a saying in B2B SaaS, which is, no one ever got fired if you buy IBM. Well, I can tell you, we're not IBM, at least yet. And by nature, no startup out there starts being an IBM. So, like, how do you get to a point in time where stakeholders don't think they get fired anymore by procuring your product? And I think there the key word is it's all about lighthouse logos. And what do we mean by lighthouse logos? Those are like the technology pioneers in the market where everyone looks up to. It's like, okay, like, if a new bank, if a Brex, if a Mercury, if they buy Taktile, then that must be something real. And I think we started 24 by closing one of those, Mercury. I wish I could say it would have been Brex. Maybe Art, you can do some lobbying for me internally. But and everyone kind of like knows in the market that Mercury, they're so sophisticated. Then if they procure a software like this, it must be a category winner, and that really has helped us to then graduate, from logo to logo, and then go to the bigger and to the bigger and to the bigger, then to the alliance, and then all of a sudden it's same product, same market, But all of a sudden, it all fell down, which I found, very, very interesting.
Amazing. And so, last word on this story. What comes next? What can we expect from Taktile now that you've got the funding?
Well, the good thing is there's so much more. There's so much more to build. Like if you build more features, you have a better product, and the better product means happier customers, and happier customers means more revenue. So we're going to invest a lot of money to make our platform really, really, really powerful in each use case. So the vision of this company is being an end-to-end platform, meaning you can use it for KYC, but you could use it for transaction monitoring, and you can even use it for claims management in an insurance company. So you got to be top in each of those verticals, and there's still a lot of things to build. So that's what we want to do. And then slowly moving more and more market to the big players of this world that need AI in their risk decisioning.
Well, we wish you the best of luck, and hopefully as you continue to expand and grow, you will come back and tell us more about it as your story unfolds. And I'm going to move us on to our next story, which is that Brex eyes $500 million in revenue as IPO is mulled. The story is in Bloomberg. Brex's enterprise segment saw 80% net revenue growth in 2024, positioning the company for future stability and potential future IPO. If you don't know what Brex does, Brex offers corporate cards, business bank accounts, and expense management software, earning money through swipe fees, interest, foreign exchange conversions, and subscriptions. The company faced a tough year in 2023 with rising interest rates and startup clients cutting back, but are now aiming for profitability by mid-2025. And of course, we're joined by Brex's Chief Business Officer on the show. Congratulations on the results. Sort of similar question as we put to Mike on his story. What more can you tell us about the sort of the growth and the opportunity behind these numbers?
Yeah, absolutely. So first of all, great description, Laura. If you ever want a job at Brex in the sales team, happy to hire you. So just
Thanks
leaving
very
that
much.
on the table as we're growing, we're growing the team. But no, jokes aside. Yeah, look, I think 2024, we're very proud of what we accomplished. This was a year where we really turned on founder mode. And I hate to be cliche, but our founder, Pedro, was very adamant about what we were trying to do last year, which was really around doing fewer things well. It was about putting the customer first, only hiring people that operate on all levels, and really raising the bar on product by having what we called a one roadmap way to ship product. And what we saw was, as you mentioned, massive revenue growth across all segments of the business, but specifically in the enterprise segment, which was a segment that we had been working to attack successfully since around 22, 23. And in 24, it finally came to fruition. And what we saw there was, yes, our base grew 91% year over year in terms of customer logos and 80% in terms of net revenue. And we added global industry leaders like Anthropic, Arm, Robinhood, Service Titan, Sonos, Wiz. I think what was different this past year is that we were acquiring these customers when they were already large. A key tenet of Brex has been growing with our customers. As an example, Scale.ai has been a customer since 2017 when they were 2 people and a startup, and we've now grown with them. But what was different in the past 18 months is we're now acquiring customers when they are already at that scale. And what that has meant for our overall business is that along with the founder mode changes, our cash burn is down. What we announced was 82% year over year. It's now down even further. And our overall revenue growth has grown 3x on a revenue growth perspective from the year before. So I think we're really excited about seeing the fruits of the labor that we had put in over the last 2 years.
Mm-hmm. Well, huge congratulations. It's obviously paying off the changes that you've put in, and particularly sort of that doubling down on enterprise clients, sort of, as you were saying, they already have that scale. Do you find it is sort of similar to what Mike was saying, that like the big names attract big names if you can sort of social proof it and say that these guys are on your books?
Absolutely. I think one of the things we noticed in enterprise is for our product, which as you mentioned, it's corporate card, it's spend management. There's a few decision makers once you're at the enterprise level, similar to my comment about the AI VP. There's not kind of a CFO in an ivory tower that is making one business decision for all back office tools. We actually believe in enterprise, there is a travel manager, a procurement manager, and a financial controller. And so for our product, we really target that financial controller. And so what that means, and the reason I think we're able to win in enterprise, is we are able to come to the table with global payment infrastructure that is unparalleled. We can offer payments in 60 plus currencies and acceptance in over 200 countries. And so when you have that, and then you marry it with enterprise grade software, that is a really important value proposition for these financial controllers. The last thing that I think we've done very successfully this year is build out our ecosystem moat. So that same financial controller that I mentioned, whatever tools he chooses in enterprise, they have to work with the tools that the travel manager and the procurement managers might have chosen. And so we've built out really deep integrations with folks like Navan, folks like Coupa, folks like NetSuite, Oracle Fusion, that really help us win the business, because we already, what we say, we're meeting the customer where they are with the best of breed solutions they're using.
Amazing. And Mike, on that sort of topic of spend management, we did recently a podcast with Pleo. Finance teams are feeling the pressure in this kind of macroeconomic environment. 66% say recessions and those macroeconomic factors have put increasing pressure on the CFO and finance team. For you as a CEO, how much does your team and do you worry about kind of spend management at the moment?
Yeah, I think for us it's a huge topic because we have offices in 4 countries. It's Berlin, it's London, it's New York, it's Liège, and I want people to see each other as much as they can. So I asked them to fly over, and if you have by now 120 people flying all over the globe all the time, this is kind of a nightmare if you don't have a spend management tool like Brex, like Pleo. So we've adopted those technologies very, very early, and it just helps you to navigate the company in a much, much easier way. And you know what's going on. So it's a big part of our internal finance stack by now.
Mm-hmm. And Sophie, on your side, sort of as a VC, as an investor, do VCs ever become involved in kind of advising or managing spend? How closely do you kind of look at that sort of thing when sort of looking after or investing in companies?
Yeah, I think it's a big part of governance when you've invested in a company. So if there is a board, one of the big things that will happen is reviewing the budget, ensuring that there is enough runway to raise the next round, and ensuring that the financial strategy marries with the product strategy and with the growth strategy. I think the big conversation in every startup boardroom and in VCs is this kind of question of profitability versus growth. And kind of pre-2021, 2022, it was all about growth at no costs, growth really, really fast. And I think post the crash, it's been more about profitability, but it has to be paired with growth. So, basically do everything and do everything well. But I think our job as investors is because we see a lot of companies, and we also see the environment in which is needed to fundraise, where we can give advice is, what does good look like? And where do we need to be to raise the right round? And that might be, how much should we hire top executives for? But our job is absolutely not to get down into the nitty gritty of budgeting, forecasting, and spend management. If your investors are doing that, I think you should be worried.
Fair enough. But on that point around sort of growth versus profitability, and sort of the changing environment that we find ourselves in, where profitability is sort of the North Star. How do you agree with that? Is that sort of the direction of travel for Brex at the moment? Or is it, as Sophie says, do both and do them both well?
Yeah, I think that it's a little bit more, as Sophie aptly said, as a VC, the VCs and our investors want us to do both and do both well. That being said, I think there is a view of sustainable growth. So I think there was a time where, especially in our space, which is the global payments market, that's a huge market. And so there was a time where folks were saying, hey, it's a market share game. Like, let's grow as fast as possible. We'll figure out the monetization later. And that's not the strategy that Brex is taking today. We have extremely strong unit economics. And when we look at acquiring net new customers, we're charging them for our software, we're giving them rebate, but we're making sure that we have the profits left over to continue investing in the tool. And one of the things that I've noticed around selling into the enterprise is actually enterprise customers appreciate that. If you're giving away everything for free, they're actually a bit wary and saying, hey, like, how do I know you're going to be around tomorrow? And like, how are you affording this account manager that wants to take me to Utah in a cabin? Like, are they going to be fired tomorrow? And so we've been able to, I think, manage that line, especially in the past 18 months. Because again, like Brex, we sell to all segments. Enterprise is just our newest segment. And so depending on the segment, you have to think through the right way to monetize and the profitability. But absolutely, it's been much more about doing both well.
Mm-hmm. And I think it would be remiss of me to say the word IPO in the summary and then not ask you about it. So, what is the thinking around that? The headline said that IPO is being mulled. What more can you tell us about that? What does that mean?
Look, I think what I can say is that, we want to be a public company at some time, but we, want to make sure that we're ready to go out at any time, and then it can be our decision. I think when you look at some of the more successful IPOs versus non-successful, I think it's always the companies that didn't have to go public that did better versus folks having to go public because of, investor pressure or things like that. And so I think we haven't made any decisions right now because obviously there's a lot of risks of going public too early, and you want to time it with market conditions. But look, I think we want to be ready to do so. And so we've made a lot of those changes in the past 12 months.
Amazing. So we wait on tenterhooks for the launch. But I think it's interesting that, you're looking at doing the right time, not the first time, that you're able. And Sophie, do you what's your thoughts on that strategy? Like, how do you decide when is the right time as a company looking to go public?
Well, that is the $1 million question, Laura. I think it's a multitude of things. It depends on the market environment. I think we are going to see a heating up of the IPO market this year, hopefully, with some fintechs thinking about going public, and then that sort of unlocks the public markets. And then if you have liquidity, that drives more interest and hopefully a kind of better success rate post IPO. You also need to be going into the IPO at a specific rate in terms of growth. The metric needs to be strong because they will be picked apart by future investors. And you also, as a company, need to be ready to make that switch from private to public and all of the extra reporting, governance and structures that you'll need to do. And that can actually be quite a heavy lift if you've been operating in this sort of agile environment. So yeah, it takes a long time. Timing is important, but once you're public, also you have the lifetime afterwards to prove to the market that it's been worth it.
Yeah, absolutely. And as you say, 2025 is sort of pegged as a year for IPOs. We're waiting for the first kind of domino to fall, which is rumored to be Klarna. In the notes it says they're potentially looking at April. That may even be brought forward to next week, rumor has it. So we're waiting on tenterhooks for all of these IPOs to start. But as Art says, you shouldn't rush it. You should do it when it makes the most sense for you. So we look forward to hearing about yours when the time is right, and keep doing what you're doing. And on that note, we're going to take a quick pause here. Back very shortly. Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like ISO 27001 and SOC 2, centralized security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Welcome back. Before we return to the news, we wanted to tell you about our latest Insight show. We're joined by guests from LexisNexis, Danske Bank, and Thistle Initiatives to talk about resilience and how financial services companies can become more resilient. A timely topic, as you'll see from the next story in this episode. That podcast is out now. Just head to the podcast below this one in your feed to listen. And right back to the news. And our next story is that banking outages shake confidence in UK financial system, and we're asking what can be done. This story in the Financial Times, but generally everywhere, last Friday, which was importantly the last day of the month, and a lot of people's paydays. Banking apps, including Lloyds Bank and Halifax, were significantly impacted with outages, with a flurry of reports on Outage Monitor Down Detector. Users also reported technical issues with TSB and Bank of Scotland, and the previous month, at more or less exactly the same time, the same happened to Barclays. These outages highlight concerns about a shift towards mobile and internet banking services, impeding people's access to physical cash and bank branches. And on the other side of the pond, TD customers in Canada and the US faced issues logging into and using various digital banking tools on Monday afternoon, which was also the same day as the deadline for contributing to an RRSP for the 2024 tax year. So this is becoming an increasingly common problem. So we want to dig into the underlying issues and ask, what can the banking industry do to try and prevent this happening seemingly every month? So Sophie, first of all, even the UK government is starting to get involved. They're raising concerns about these outages, sort of writing to banks, kind of trying to figure out what's going on, requesting details on the kind of impact of the IT failures. They've asked about the frequency and how long they last, and basically just gathering information. How worried should they be that this is a repeated occurrence? How worried should we all be that this is a repeated occurrence?
Yeah, and I think just to bring this to life a bit, I am a Barclays customer, and I am also a business owner. And last month, I had to pay my self-assessment tax return. I obviously left it until the last minute. I needed to pay on Friday, and Barclays was down. And I couldn't pay it, and I got a fine because the payment needed to happen at that time. So it's very frustrating, and it's very frustrating that it seems to happen at these points where important things need to happen. You receive your salary. If someone's living bank check to bank check, then not receiving their salary on a Friday could really impact defaults on loans and credit cards and things. So it's really, we could talk about, and we will talk about why, but the actual impact on people is really real. And I think we've seen a lot of them were actually talking to a company where was working with a bank, and they're having to sort of delay some of their product sort of roadmaps because they're worried about these outages. And I think there's kind of a couple of contributing factors, and I'm sure there's a lot more, which is this move from digital to digital banking has happened at such a rapid pace that I think the shift hasn't, the technology hasn't really caught up, and the demand is kind of outpacing what this outdated technology can do. We're also seeing such rapid technology change in terms of innovation with banks and fintechs that actually, again, do these outdated infrastructures really match up? So I hope that banks are taking this seriously. And I know there's a lot of solutions out there that's supporting this, but I think this will end up being more of a common occurrence.
Mm-hmm. And are we seeing similar conversations happening in the US? Obviously, the TD example is like the most recent kind of outage over there, but is it happening as frequently, and is it having similar concerns?
I think there are. I mean, I share the same concerns as Sophie. I think you mentioned TD. There was also the Capital One outage in January that just raised questions about the robustness of the systems. But I think it comes down to the reason that, companies like Brex and Taktile are generating such traction, which is that these US banks are built on legacy systems that date back for decades, that can't handle the demands of modern transaction volumes. Specifically, Sophie, you mentioned it happened around the time of this tax event. I don't think that's a coincidence. Obviously, it's inconveniencing customers at the exact wrong time. And so I think legacy infrastructure in both the US and UK is a serious weak link.
Absolutely. And Mike, on your side, obviously, industry experts are saying banks need to strengthen their resilience and sort of modernize systems, etc. That's a very easy thing to say, right? What's the challenge to kind of improving resilience to resist these kind of outages?
Yeah, I mean, differentiating a bit between the different sizes of banks. I mean, JP Morgan spent $17 billion last year on tech. And all but the largest banks, they can hardly afford this kind of spending. So looking at, say, the smaller community banks, they just lack internal IT and dev resources, and they're highly dependent on the core banking providers. And that is just significantly hamstringing their flexibility and ability to innovate. And it also doesn't allow them to respond super fast to any changing environment. So I think there's it's the different players in the market, and I think at least what I do appreciate right now in the US, that the government is doing things. They're trying to innovate. The long-awaited launch of the Fed now, so the Federal Reserve's real-time payment system, it's coming. And at least it demonstrates that the central bank is capable of developing new technologies.
Is it coming though, Mike? Is it coming? It's been coming for a long time. Fed now, I don't know. I'm not as optimistic.
You are in the trenches of it, and I'm pretty sure you guys have a good solution to get around it.
That is true. We do.
But on the subject of solutions, sort of, Sophie, as you mentioned, we're kind of reporting on the outages, we're kind of worrying about the regularity of it, but obviously, sort of, just reporting on it happening is only half the problem. What might the solutions be? What is the most sort of important solution? Is it improving resilience? Is it innovation? Is it technology? Is it greater governance? Where do you think we should start putting our focus to fix this?
I think it has to start with the underlying technology, because that's what is fundamentally driving everything that we're interacting with, and also driving the outages. The problem is that the overhaul of the core technology is a huge outlay, and it's a big risk, and it involves a lot of migration and cost and time. And so that's why we're seeing this kind of plaster approach, where instead of going and kind of redoing your core tech, you're doing a nice digital front end or partnering with a fintech. And what I think we'll see, and let's see, is that is the answer to move your banking to fintechs, because they have been built with technology in mind. They're obviously the fintechs have their own problems, which you've discussed at length sometimes. But I think it's got to be, we've got to stop putting plasters on it, basically, and treating the root cause, which is really tough. It's very easy to stand here and say this, but I think it's interesting to see who's going to take the first leap on that.
Yeah, ripping out the technology is basically the job that everyone's been putting off for ages, right? And so do you think maybe, you're kind of alluding to things taking too long, but do you think we're going to get to a point where you may not have a choice, as in there isn't a good time to change your technology, but are we going to get to a point where you're kind of hands forced because the outages are so common and costly that something has to be done? Are we going to reach critical mass, do you think?
So I think it's a really challenging problem for the legacy banks. And I guess I obviously have a vested interest here, but I think that if you look forward 30 years, the banks of tomorrow will be the fintechs of today. I don't actually believe necessarily that the legacy banks can fix this. And the more times that Sophie runs into problems with her, and there are these outages in the UK, I think people will just move over to banks like Revolut. And if it happens in the US, they'll move to Brex and to other fintechs. And so I think actually that this is an existential problem for the banks. And it's the reason we're so well set up is because companies like Brex, we own our own financial infrastructure. We've done the work of picking pretty painstakingly the partners that we think allow us to build quickly and delightfully and without outages. I remember early on in Brex's history, 2019, we had a 20-minute outage, and it was like an existential event for the company. Because, right, like if your card doesn't work, like you don't have a business, right? And so I think that if we have that in our DNA, and other fintechs do as well, I'm sure, whereas the legacy banks are having all these outages, it's not going to work out for them.
And Mike, what's your thoughts on that? Like, obviously, we know that like public confidence in big banks hasn't been great since 2008. Do you think these outages just kind of reinforce that? Is Art's prediction right that everyone's just going to move over to fintech because it's just more reliable at the end of the day?
I think it's a realistic chance. I mean, like there's a lot of market power of the banks, but if you ask me if they can fix their legacy infrastructure, I think it's just very, very hard. What I've seen for some banks is that they've started to build a very modern second, like parallel infrastructure. But I think that's like 1 out of 100, Do I think that they can be dangerous to the fintechs then, or like at least keep their market power? I think so, yes. There are enough infrastructure players right now in the market that allow you to just build very, very fast. Why could like someone like Brex grow so fast? Because they just could build a completely like infrastructure in a couple of years. So if they can do it, other people can do it. But like I don't believe in changing the legacy infrastructure. But if you have the balls as a bank CEO to like build a second parallel system, I think there's a good chance. But I mean, like, not many do that. Hope is not lost.
That is a good place to leave this one. But yes, hope is not lost. We will see how they get on. But yes, it is an incredibly daunting task to change all the underlying technology. But at some point, it's probably going to have to be done. Otherwise, this is just going to continue. But I'm going to move us on to our next story, which is that Aberdeen, spelled Abrdn, to become Aberdeen in undoing of ridiculed 2021 rebrand. This story was in Bloomberg and many other places. UK asset manager Aberdeen has rebranded itself back to Aberdeen with all of its vowels, I should say. This is quite hard to do if you can't see it written down. After it was widely ridiculed for removing most of its vowels from its name in a 2021 rebrand under previous chief executive Stephen Bird. However, new CEO Jason Windsor has reversed this decision, saying it makes it so much easier for us to spell it out in full and move on. The company said this move would end distractions. However, under a new change, the company also spells its name with a lowercase a instead of a capital, causing more confusion. The company is also aiming to turn the tide on its recent losses. Windsor told reporters he was committed to retaining the company's 3 core businesses, which are investments, advisor, and interactive investor. In its interactive investor business, the company said it was targeting customer growth of 8% per year, while it was also seeking to book at least £1 billion of net inflow into its advisor business by 2026. Okay, so this is sort of a slightly silly story with a more serious course. So, Sophie, what do you think of this one? Obviously, they've gone after kind of no distractions. We've got a sort of grown-up name now. However, a lot of the headlines have been about sort of just the flip-flopping around with their name. What do you think? Is this a way to draw fresh attention to the brand, or is it actually doing them a disservice?
Yeah, I really liked the Guardian's headline for this, which was vowel movements. I think having just undergone a rebrand myself, so the company that I run for women in VC, Unlock VC, used to be called WVCE. It's a nightmare of a process. Anyone who's gone through a renaming of a business, you're like searching for the perfect name. You can't decide. You like go back and forth. You ask everyone, and you hope that it's going to be the right name. I think this kind of screams wanting to feel more like tech and more like kind of innovative. And then, I mean, we went through it. We were WVC, and then I dropped the E. And I realized that was insane. So I added back the E for like a month. So I think it does happen. But it's, you know, what people kept telling me is the only person that really cares about your name is you. If you have a great business and you like your customers love you, then they'll just adopt the name and it's great. Whereas if you're changing it because you're hoping that will like reignite your customers or help your customers think differently about your proposition, that doesn't work. And even the kind of going to lowercase a is you know, if you look at Airbnb, Amazon, Facebook, it's a very tech thing to have a lowercase thing. Where a lowercase, by the way, it's an absolute nightmare because everyone spells you with an uppercase. So yeah, I think it's just a kind of a way to maybe reinvent the business without actually reinventing the business.
Yeah, I mean, on that point, kind of the no distractions, but it sort of is a distraction away from what they do as a business, and equally, you know, they're undertaking this massive loss cutting exercise and trying to attract a bit more of a sort of higher, wealthier individuals to them. Does a name help them do that, or to your point, you know, they're either in because of the business model or they're out? What do you think, Sophie?
Yeah, I think you've got to like, customers want to do business with you because you have a great product, and if you don't have a great product, then a name isn't going to help that. Yeah.
So on that kind of loss cutting side of things, you know, they've been quite a traditional player in the space who've had their sort of finances squeezed due to competition from BlackRock, from Vanguard. They're looking to sell off peripheral businesses, pulling back to what they do best. Kind of art. How important is that to do in this current market, to kind of turn the tide against competitors, to kind of pull back to what you do best, essentially?
Yeah, it's a great question. I think that in today's market, you're seeing a lot of fintechs and just tech companies in general really compounding on their core business rather than trying to do too much. And that's something Brex did and focused on our core customer in 2024. I think, though, it is a cycle. It's like they say, like the bundling and unbundling, that, okay, you do that, you slim down, then things are working again. And then you say, okay, well, everything's great. Like we need to keep growing. The VCs are telling us to grow fast again. So like, let's go back into another new product. That being said, I think that compounding is a real, obviously it's a real phenomenon. I read a really interesting tweet the other day that was like, just remember, even if you're only growing 5% a year, you're still compounding. And I thought that was really interesting in the sense of like, of course, we're growing and Taktile's growing much, much faster than that. But the power of doing the same thing over several years and compounding in the base is really important. And when you jump to something new, you have to restart that all over again. And I'm not sure I think people underestimate how hard that is. And that's why you see folks pull back.
Yeah, I think for us, like, it's interesting. I mean, like, of course, we are growing very fast, but we have a much smaller baseline than Brex, so it's also easier. But I think like we are right now, I think like we're not, it's a very competitive market. It's kind of like the AI gold rush, you know, who like everyone, you know, who panics, you know, if you panic first. So I think for us, it's really the land grab moment. So we don't really look so much at, you know, profitability for the moment. It's just about who wins the category. Because like people associate certain brands with a category. You say like, oh, if it's like cloud observability, that's Datadog. If it's whiteboarding, that's Miro. If it's interface design, it's Figma. And right now the question is, you know, if you think about AI risk decisioning, you know, it's Taktile. And I think we are like in a very good way of like of getting there. But you know, you don't want to lose speed right now at all, which is why I look at kind of competitive situations very differently. And it's just, you know, pedal to the metal at the moment.
And I guess sort of you don't want to, and I guess what their new CEO is doing is kind of pulling back on a lot of sort of other things that they did that maybe took them away from the core business. And to your point, then people don't know exactly what they do because there's so many other things under their umbrella that they could go in lots of different directions, instead kind of standardizing and pulling back to the kind of core 3 points that are going to put money on their books, essentially. Do you think that's a pretty sensible move, Mike?
I think that's hard for me to say, to be honest. I don't think I know too much about the business to comment well on that.
Okay. And Sophie, on the sort of, not to harp on about the name change, however, is the kind of like the name change and the strategy kind of a classic case of an incoming CEO wanting to undo the legacy of an outgoing one, or is there a bit more to it than that? Before he left, Stephen Bird was insisting that the previous name with no vowels would stay unchanged. Almost immediately, the new CEO reversed that. Is that just kind of gameplay? But equally, on the other side of things, like, it seemed to have worked. Like, share prices rose 11% immediately after the announcement and grew up to 15% since. Like, is this gameplay, or is it just a clever move?
I mean, I think it could be a little bit of both. As an incoming CEO, you're able to bring a fresh pair of eyes and also be able to kind of talk to people and really go, okay, this, you were along with this idea with the last CEO, but actually, what do you think? And, because I have the power now to kind of do things differently. And it's a very public showing of your transition to CEO, isn't it? Completely changing the name of the company. And so I think there is probably a little bit of, I'm here and I'm here to change things and I'm not afraid to make big changes. But I also I imagine, given our reactions to the name, a lot of people in the company weren't that happy with the name as well. And once you go in and you do your sort of, discussing with top execs, what are the big things that you think we could do differently, that might have come off quite a lot. But I think this kind of move to appear more serious, to be taking, focus on the core, prioritization, it all kind of goes, it's a really nice story.
Mm-hmm. But yeah, as you say, like, there's kind of almost no bolder move as an incoming CEO to just completely change the name of the company. So he's definitely making a statement with that, which again, I mean, in a way, we've sort of fallen into his trap, which allows us to then start a conversation about what he's actually doing as a new CEO to reset the business. So it's quite clever in a way. But yeah, it'll be interesting to see how, like, whether that initial kind of uptick continues. As you say, like, they spent an awful lot of money on that rebrand with an external agency advising and so on and so forth. The new CEO has been very abrupt in saying it costs us nothing to change this name. We didn't get any external support. We just did it. Again, kind of making a statement on sort of spend management, if nothing else. So the guy is definitely making waves in this space. And I guess we'll just wait and see whether Aberdeen take 2 works out for them. Okay, now for a quick look at one more news story this week that we don't have time to cover in full, and that is Ramp, a 6-year-old fintech startup, has more than doubled its annualized revenue to $700 million. The story was in TechCrunch. Ramp, a fintech company offering corporate cards, expense management software, and financial products for businesses, has surpassed $700 million in annualized revenue as of January 2025, more than doubling its revenue in under 18 months. The company reached $100 million in revenue before its 3rd birthday and now holds 1-2% of the US card market. Ramp is reinvesting heavily into R&D, spending over half of its payroll on product development, and is not yet profitable by choice. AI has helped Ramp reduce cash burn to under $2 million per month by improving efficiency across various teams, and Ramp's valuation has nearly doubled to $13 billion following a $150 million secondary share sale. So firstly, huge congratulations to Eric and the team, friends of the show and previous 11FS award winners. They've obviously gone from strength to strength to have reached $700 million in revenue, which is almost double where they were at in August 2023 when they posted results of $300 million. And this is obviously huge. In addition, obviously their valuation has more than doubled in a year to $13 billion following a share sale, which are just amazing numbers in the current environment, especially with such stiff competition in the card market. And likewise, being not profitable by choice is a super bold move. In the current environment, we talk about it a lot on this show, where every fintech appears to be striving towards profitability as fast as possible and or being judged on not having got there yet. However, Ramp are confident they could get there if they wanted to and are using AI, as is, I imagine, everyone, to reduce cash burn. Instead, they want to reinvest revenue into growing and developing their products, showing confidence in the opportunity space and also their own ambitions to take more and more market share. I reckon they can probably do both, grow, innovate, and reach profitability in the very near future. And I'm excited to see what they do next. Okay, I'm going to move us on to our "and finally" section now, which is a little bit of a different note to end today's show on. So on today's show, we're going to talk about a call to the industry on funding women this International Women's Day. So when the show goes out, this past Saturday marked International Women's Day, which is now over 100 years old. International Women's Day honours the social, economic, cultural and political achievement of women around the world. It is also a day to raise awareness about gender inequality and advocate for gender equality and women's rights. This year's theme is Accelerate Action, and we want to use this platform to discuss an area of financial services where action needs to be accelerated: investing. Some stats from a really inspiring Medium post by someone you might know. Our panelist today, Sophie Winwood. Only 2% of venture capital funding goes to all women teams. And this disparity is even more pronounced when you look at the data from an intersectional perspective. For example, only 0.34% of venture capital funding goes to Black women startup founders in the US. So, Sophie, you've written extensively about the stark contrast in venture capital funding for female-led teams. What can be done about this? How can everyone listening to this podcast help us to bridge that gap?
Yeah, thank you for allowing me to talk about this. I think it's a big passion for me, and the stats are so bleak, and they're not getting any better. They're actually getting worse. I've been a VC investor for 6 years, and they've actually got worse in terms of VC investment into all female teams. And we really do need to stop talking about the problem and start implementing change. And so there are a couple of ways that I think us as an industry, a VC industry and a startup industry, can support. Firstly, if you're a VC fund in the UK and you haven't signed the Investing in Women's Code, I would really advise that you do that. For those of you that don't know, it's a code that requires signatories to nominate a member of a senior leadership team to be responsible for supporting equity. It means that VCs have to report their pipeline and then their funding data so that we can track it, because we can't change anything until we know the data. And it also promotes the adoption of internal practices to improve female entrepreneurs' funding. So, looking at unconscious bias, for example. The other thing that I think is really important is, so there's 250 signatures of this code. That's about 47% of the industry. So the rest of 50% need to sign it. But there are only 2 signatories that are LPs. So LPs are institutions that invest into venture capital funds. And if you look at the stats around senior women in venture funds that have decision-making power, that's only 16%. And we know that female investors are 2 times more likely to invest in women. So that's my role in Unlock VC. We want to get more women to decision-making roles. And that is really kind of VC funds. Look at your hiring practices. If you're a man in a VC fund, consider being a sponsor of a woman in your team so that you can really be responsible for their career progression. Consider being a mentor to a woman outside of your team to support them, to help them stay in the industry and progress. And I think in terms of everyone, it's opening up your networks to female investors, to female entrepreneurs. It's making sure that they have access to the networks that you have. It's recognizing their work. It's promoting them over your social channels, and kind of really being that empowering ally or supporter to enable women to kind of get into these funding circles and can progress through the VC capital stack.
Fantastic, thank you. And Mike, you're both on the C-suite at highly successful fintechs, as discussed on the show. What do you see as the benefits of a more diverse leadership and employee base in startups?
Yeah, I mean, diversity in leadership, and across the startups team in general, I think isn't just the right thing to do. I think it's a massive competitive advantage. So we have 50% of women in our leadership team, and you can really feel the impact. So I think when people with different backgrounds and experiences and ways of thinking, they collaborate, they can challenge assumptions and they come up with more creative solutions. I think that's one big thing. And the second big thing is now for us, we talked about it at the beginning of the show, it's we have to scale the company. And I think diversity is so critical of scaling a company. It just helps us to attract top talent much, much, much easier in the market, and also to build a culture that is resilient and that's also adaptable. And I think both of those things are really essential for the success of a fast-moving company like ours.
Yeah, I would echo a lot of what Mike said. I think democratizing finance is at the core of why Brex was founded, to enable founders of all types to build and create businesses. And so we mirror that internally in the diverse leadership, in the fact that we have very diverse leadership, and we believe that obviously is the right thing, again, as a competitive advantage. I totally agree. We want to, and the way that I think about my organization, you want to hire and promote folks who come from different backgrounds, because that is a competitive advantage, and specifically critical to winning, especially in today's world.
Sophie, how optimistic are you about the sort of tide being turned here? We're in a climate that you've equally written about, where kind of DEI initiatives are being kind of removed, reversed, or just generally under attack. What's your kind of thoughts about the direction of travel here, and what you'd like to see change there?
Yeah, I mean, it's hard to not be slightly depressed about the direction of travel at a macro level, in terms of every day you see a news article about another large corporate rolling back its D&I policies and targets, it's quite disheartening to see. But I think the exciting thing is that there are these, non-consensus companies, 2 of them obviously on this podcast, which is incredible, who are, not taking note of this. And I think those companies will be on the right side of history. All of the data proves that more diverse teams are more successful. And I think the fire that you see that is being ignited by these kind of backlash of D&I is going to put all of the companies that are not doing it in a really great position. And I think specifically for Europe, this is very US led. If Europe can kind of take advantage of this and go, no, we're not following the US here, we're kind of looking at our own path, then I think we'll see huge successes, and we'll come out on the right side of history, which is exciting.
Amazing. Well, let's very much hope that is the case. And thank you for sharing so passionately with us everything that you kind of are championing, and what we can do to make things better for female entrepreneurs. And for the weekend, happy International Women's Day. And that wraps up this week's FinTech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you and your companies, starting with you, Sophie?
Yeah, you can, I think we're all just on LinkedIn now. You can follow me on LinkedIn, Sophie Winwood. If you want to know more about Unlock VC, or if you're a woman in VC and want to join our amazing community of over 1,000 women in VC, you can head to our website, unlock-vc.com. And then if you want to find out more about Foxe Capital, we are an early stage investor into Europe and US companies. Head to foxcapital.com.
Brilliant. Thank you. Art?
Yeah, I'm also on LinkedIn, Art Levy, or folks can email me, Arthur@Brex. If you're a global founder and you need a corporate and spend management solution, please email me directly or go to brex.com.
Thank you. And Mike?
Similar story, Taktile.com with a K, and the same thing for LinkedIn. That we keep it simple.
Lovely. And, completing the group, you can find me on LinkedIn, Laura Watkins, or otherwise on 11fs.com or this podcast. So thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share this podcast with a colleague or friend, or anyone really. As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider, or email podcasts@11fs.com. Thanks again, and goodbye. Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.